You're watching Wall Street Confidential. I'm Farnoosh Torabi. This is Jim Cramer. Hi, Jim.
How are you?
We're going to do a follow-up on your four horsemen,
Right.
Apple, Amazon, Research in Motion, and Google.
Well, I want to say point blank, first of all, I will return to this theme many times. One of the things I've learned on Mad Money is that you should return to a theme maybe 20 times because the theme has to be something that people feel comfortable with and are by rote with, because the themes are meant to transcend the declines. They're not necessarily meant to be able to be something you periodically think about. They have to be ingrained, because when you have a decline, it's going to happen instantaneously. The decline we had yesterday, when we went from down 60 to down 50 to down 140, occurred in a compressed period of time, from 2:47 to 4 o'clock. Without a thesis like the Four Horsemen in your head, you will either panic because the media wants you to panic, or you won't remember what to buy. Mm-hmm. That's the essence of the Four Horsemen.
All right, let's go to your thesis about Apple. The iPod is coming out soon, and let's talk about how you plan, how investors should buy Apple at this point.
All right, let's understand each other for Apple. Mm-hmm. There's been a lot of confusion, both in Stock Picker and in the general media, what I've been saying about Apple. I recommended Apple in the mid-'80s. We then pick up 40 points. When we're up 40 points, bulls make money, bears make money, hogs get slaughtered. There's not really an issue here. If you haven't taken something off the table at 50%, you're a fool, whether you like it or not. The essence of my style of investing is just these are stocks. They're not lovable objects. When something's up 50% and you haven't taken off the table, I regard yourself as being irresponsible. I like to be a prudent investor. I don't like to look at what could happen with the company. I like to look at what happened with the stock. Now let's diverge and talk about the company. I think the iPhone is going to be a huge success. It doesn't matter. The stock obviously reflects that huge success. So when it got to 125, I recommended scaling some out to get down to 50%. Got back to 115, I said add a little here because that's my Four Horsemen philosophy. I think a lot of people who come to the site, a lot of people who read in Stock Picker, are not used to conflicting disciplines. So let's take a moment before we do the next video just to spend a little bit more time on Apple. Mm-hmm. The conflicting discipline here is the need to lock in a profit versus finding a stock you really like. And all my life, I've been concerned about two things: the loss side of the ledger and the gain side of the ledger. If I can minimize the loss side of the ledger, then I know I'm going to make a lot of money with my gains. But one of the ways to do that is to be sure you've taken some profit. If you take some profit, they can't take the profit away from you. People hear this and they say, well, didn't he say he liked Apple? Mm-hmm. That is irrelevant. Discipline always trumps conviction. I'm going to come back to that theme. I've left that theme off of my columns lately. I see people don't get it. Discipline trumps conviction. Those of you who think that conviction trumps discipline, you'll never make any money.
So don't be emotional about the iPhone, even though some critics say it's going to go, it's going to
I
flop
don't care.
the first generation.
So I hope so. I am getting one through AT&T. They've told me that there are very few that are actually available from the beginning, and I'm going to lock in one. I had to speak to the CEO to get it. To tell you that I had to go to the CEO to get an iPhone, I think is a very indicative sign of the demand here. It doesn't matter. You sell half.
Well, let's move over to Research in Motion, which has been viewed as a contender to Apple with the iPhone's release. But RIM's got some BlackBerries that we just reviewed one on our site that seems to be really keeping up to speed with Apple's iPhone.
Here's the way I like to approach that. I don't want to look at it as RIM or Apple. Okay. I want to look at the universe of people who want these devices.
Smartphones, yeah.
Yes, and then take a look at how much Apple and Research in Motion have share of. Mm-hmm. Tiny, not that big, can take much more share. Research in Motion is not. There have been many conflicting companies. There's been Hewlett-Packard and Compaq and Dell, and there was no one ever said there was no room for all three. History is filled with technology situations. Nokia, Motorola, and Ericsson were a terrific oligopoly in the 90s, and people made money. It is only quite recently, ever since the decline in 2000, that the fear has overruled the possibility of successful investing when it comes to growth. Both Research in Motion and Apple are exceptional growth stocks, and they should be on your sheets. You should own them. As they spike, you sell some, and then as the market takes them back, you buy them back.
Let's turn to Google. You say this stock has a lot to thank to that YouTube is really what's fueling this stock.
YouTube has 7% growth per week. I have never seen that in my lifetime. That's remarkable. The only time the press talks about YouTube is with litigation versus Viacom. YouTube is viral. It's really important that people recognize. I got this from Ivan Seidenberg, who's talking about the need for more bandwidth because of YouTube. You should be buying LVLT off of YouTube. It's just what you should do, and you should be buying Google.
All right, and finally, Amazon has had a nice little pullback. Why is this still
Amazon's a hated
stock?
stock. I like it because of a very big short position that just increased during this period when it's clear that revenues are accelerating, gross margins are accelerating. That's just wrong. I mean, I can say that's wrong because there's a possibility it's 8 out of 10 wrong. Okay, there's two out of 10 that says that that's right, that the company's peaked, and 8 out of 10 that says that it's accelerating. And I'm going to go with the odds.
All right, that has been a review of Jim's latest 4 horsemen: Apple, Amazon, Research in Motion, and Google. 4 horsemen that are still on the move despite a downturn in the markets. Thanks so much, Jim Cramer. You're watching Wall Street Confidential. I'm Farnoosh Torabi. Stay with us.